Hello and welcome to the investment review for September 2014, during which we'll be looking back across the later part of the summer at events that have affected our investments and also casting our eye forward as to general outlook for the remainder of the year. Equity markets succumbed to profit-taking toward the end of July as rising geopolitical tensions, such as the increased Russian sanctions and continued violence in Gaza, outweighed generally good economic data and a positive corporate earnings season. After achieving another new all-time high earlier in the month, the S&P 500 retreated 30 points to end July at 1,930. Held back by sterling strength, the FTSE 100 has lagged Wall Street this year and ended July down 13 points at 6,730, leaving it little changed on the start of the year. The FTSE 250 and small cap indices fell slightly more in percentage terms. Lately, as the summer months ended, the FTSE has gained some traction to move nearer to the 6,900 point mark. With a look at markets, weakness in the core German and French markets left the FTSE Euro First 300 index down 21 points at 1349. The Nikkei 225 picked up toward the end of the month to end 450 points higher at 15,620. Asian and emerging markets continued their strong recovery, ending the month at or near year highs. Despite some profit-taking in high-yield bonds, fixed interest securities continue to defy skeptics, with the UK 10-year yields down 7 to 2.6%. Industrial metal prices firmed again in July, but energy, Brent crude at $104, and agricultural commodity prices weakened. In a little review of worldwide outlook, and beginning in America, strong Q2 GDP growth continued and confirmed that the US economy was back on track. Investor attention is now focused on the sustainability into the second half of the year as the Federal Reserve completes the removal of the extraordinary stimulus measures and the interest rate cycle turns. Business surveys are very strong, as are hiring intentions and capital expenditure plans, especially by smaller companies. But it is the mixed signals from the labour market which remains the focus of attention. The trend in job creation has recently slowed, while at the same time employment costs have picked up. But with more workers re-entering the jobs market, it's hard to see wages accelerating sufficiently to force the Fed to remove their accommodative stance anytime soon. The lull in the housing market will likely pass as consumer confidence outweighs the normalisation of mortgage rates and winding down of post-crisis housing inducements. Aside from autos, real estates are steady with some signs of a pickup in discretionary spending, such as restaurants. Across to Japan, the Japanese government appears to have misjudged the impact that yen weakness might have on real disposable incomes. Export volumes have not risen as expected, with extra foreign demand for Japanese products being met from overseas rather than domestic production. In turn, wage increases have remained modest, while real disposable incomes are being eroded by higher energy costs. This could explain why the post-consumption tax recovery has disappointed, leaving the increasingly unpopular Abe administration with the politically awkward decision this autumn as to whether to proceed with the Phase 2 consumption tax hike in 2015. Some structural reforms are being implemented and equity valuations are attractive, but catalysts appear to be absent. It's maintained a very steady growth rate of around 6% over the last 2 years, as the lack of structural reform, weak productivity growth, slower exports and subdued domestic demand have counterbalanced the longer-term opportunity presented by demographic trends. Recently, there's been some signs of a change with a pickup in exports and manufacturing price managers indices for India, Taiwan and China, where the policy mix has turned back in favour of growth. We would expect the growth rate to decelerate, but with valuations still very favourable, these markets should theoretically continue to perform well. Turning our attention to the Eurozone, prospects are more uncertain, and there's a marked disparity in short-term economic performance across the region. After a strong start to the year, Germany is experiencing a period of slower growth, with lower manufacturing activity and increasing geopolitical concerns. The French and Italian economies both remain weak and will show only modest signs of improvement in the coming months, although exports are growing at 3% per annum. For the moment, the peripheral economies show the biggest improvements, most notably Spain, Ireland as well, and Greece, and even Portugal. Despite the continuation of deleveraging in Spain, private sector consumption and business investment have picked up, and a boost in tourism is helping Greece and helping Portugal exit their very deep recession. Even optimists are surprised at the re-emergence of the Emerald Tiger, with Irish exports estimated to grow nearly 8% in 2014, helped by a surge in pharmaceutical output. Estimated GDP growth of more than 6% means that Ireland could top the Eurozone league table this year. Structural challenges remain and unemployment is uncomfortably high at 12%, but government cutbacks are helping balance the books, and the public debt to GDP ratio is on track to decline to 110%. UK economic growth could be as high as 4% year on year and is increasingly broadly based. The improvement in real disposable incomes and rapid decline in jobless numbers towards 6% mean that a wider spectrum of the country will begin to feel the benefit as the year progresses. While pay settlements are modest and inflation pressures subdued, central bank monetary policy communication is now paving the way for the first interest rate rise later this year. Given that markets have largely anticipated the turn and rises should be gradual, this shouldn't derail the economy or the equity markets. Export growth is lagging, but this is probably as much due to Eurozone weakness as currency strength, given that on a trade-weighted basis sterling is only around the 20-year average level. The Scottish referendum remains a wildcard, as markets are not anticipating a vote for independence. To bring this review to summary, pundits remain positive on the outlook for risk assets in the second half, as the good macroeconomic background is backed up by positive news from company results, where earnings and increasingly revenues are showing signs of improving, not just in the US, but now also in Europe. However, short-term fears over the impact on European companies of increased sanctions on Russia could cause further uncertainty. As we said earlier, bonds continue to defy the sceptics and have outperformed equities year to date, but this is unlikely to last as we approach a possible turn in the interest rate cycle at the end of this year. This is an area that we continue to watch very closely. As usual, our contact details appear on the final slide. Please feel free to call us at any time to ensure that your plans are on track and that critically we continue to maintain your investments in line with your appetite toward investment risk. Thank you for listening.